I haven't started it.
How was everybody's weekend? Good. Anybody here volunteer for VITA over the weekend? I did over the weekend. I saw Anthony walking around. I saw Adrian as well, but yeah, I was doing the assembly work for VITA. This is my first year volunteering. I've been here for 11 years. Dr. Keaton, I won't say she bullied me into it, but let's be honest, she bullied me into it. I was going to do it last year, but last year was very, very busy for me. So I said I would do it if I survived last year, which that was about a 50% possibility. So yeah, I went there and I did assembly. And I have to admit, it was a very interesting experience because it was very obvious I was not one of the students. But I got some questions and I'm like, let me ask Dr. Deers. And bless that poor lady. She was very patient with me, very patient with my questions. Like, you have a CPA, don't you know this? I said, I probably should, shouldn't I? But we got through it. We got through it okay, and only 2 more to go. I do have some sympathy now for the VITA work that you do, especially the VITA GTRAs. They basically spend 9 hours there, and then they come back and do the e-filing. So if you want to be nice to people, be nice to the VITA GTRAs. And if you want to be a VITA GTRA, look out next year. So yeah. Quick notes about this week. So I think I've got the assignment corrected. Ozzy let me know at the beginning that the homework assignment was posted on Brightspace for the wrong date. It was like due a year from now, which obviously was an incorrect assignment for the date. I'm not sure why, but a year from now. But it has now been corrected. The homework assignment is pretty straightforward, but I do think you probably should make a note about the idea assignment. The idea assignment is worth 10 points, but that's for a very big reason. It is a much more complex and onerous homework or idea assignment than other assignments. And it will take you some time. If you try to do it on Friday before class, you likely will not finish. So something you should be aware of. Obviously, the idea assignments are not required, but I'm guessing that a lot of people who started that want to continue on because that's going to be a way to get additional points in the class. So just be aware of that it will take you a little bit longer than the other idea assignments. I don't particularly think it's particularly difficult, and we are going to walk through some of those things that you need to know for the idea assignment on Wednesday when we talk about sampling. Some of these are a little bit foreign concepts, especially if you spend some time away from the statistics class. But idea is actually really useful for the tools that we're going to need it for that. So it'll be a good opportunity to get some introduction to that. Yeah, and I believe that's it for that. Quick note about the lectures moving forward. You may notice that this is chapter 7. It doesn't say chapter 7 part 1. This is just chapter 7. All of our lectures moving forward are going to be covering one chapter, and that's it. It's one shot done. So you can probably guess that we're moving at a much more accelerated pace. We will not cover every single detail that the chapter has to cover. I've kind of winnowed out some of the information that I think is not relevant. So we're going to be covering it a lot more quickly. That being said, it is high level detail, but you will be responsible for everything that's been assigned. So it's kind of the nature of this particular course. And I try to make sure I cover everything in the book that I think is relevant, which means that we're going to spend a lot of time going through stuff. So it's a little bit faster from here. Hopefully not my speaking voice. My speaking voice is already way too fast. So yeah. All right. Auditing over internal controls or financial reporting. So we talked about the acronym or the abbreviation, I should say, the abbreviation already. You're going to hear me refer to this as ICFR. If you go to work in public practice, you'll probably hear them call this ICOFR. That's just kind of the standard acronym. So it's internal controls over financial reporting. And where does this emanate from? It goes back to those objectives that we talked about back in chapter 6. Remember, we had 3 objectives related to internal controls. And we said reliability of financial reporting, effectiveness and efficiency of operations, and compliance with laws and regulations. All 3 are important, but one is more important than the other with respect to auditing. This is auditing has to do with making sure we understand the generation of financial statement information. We have a specific focus on controls over financial reporting. So we're going to be extending some of the things we talked about in chapter 6 today. In chapter 6, we talked about controls at a very general level. We talked about how we're going to approach testing of controls and what are some considerations. Now we're going to be talking about some of the specific concerns and how we actually categorize information with respect to internal controls over financial reporting. I will say that it's not necessarily new information, but it's a little bit more granular information, which means that we need to understand a few more details. We're actually going to walk through an example of how we would do a test for internal controls over financial reporting, which I think is going to be helpful. And then we're going to do a couple of examples of how we would assess control deficiencies. I've got some notes on that, so people pay close attention on that because I will give you some details that are not necessarily intuitive, just given the way the homework operates. Anyway, Section 404 of Sarbanes-Oxley Act deals with the internal controls organizations. So basically, it requires managers of publicly traded companies within a certain reporting threshold, which I don't say that in the slides. I just generally say publicly traded companies. I believe the threshold right now is $100 million in annual revenues. It used to be smaller than that. But public companies with over $100 million in annual revenues have to issue a report that accepts responsibility for establishing and maintaining adequate internal controls over financial reporting. And they have to assess whether the internal controls over financial reporting are effective as of the end of the fiscal year. Now, this is an important point because these seem like they should be natural responsibilities, but these are specifically defined according to the Sarbanes-Oxley Act. So management has to accept responsibility, and they also have to make their own assessment of internal controls. Now, this goes against what we've talked about already. Remember, we talked about management's responsible for design, implementation, and maintenance of internal controls, and auditors responsible for testing those controls. This tells you something different. It says publicly traded companies, managers have to do their own independent assessment, which is really important because we're going to be making our own assessment of internal controls requirements. And if those do not line up, then there's going to be a lot of turmoil, a lot of strife in between what's going to be reported. But this is kind of an exception to that rule. For publicly traded companies within that threshold, managers also have to assess internal controls. They have to do their own testing. So kind of an interesting little caveat to our rule that we've talked about already. Now, what do auditors have to do? They have to audit management's assessment of the effectiveness of ICOFR. So they have to test controls. And as part of that, they are going to assess whether management's assessment is correct. So assessing an assessment effectively. They're going to audit that and say, yeah, management's right, their internal controls are working, or they're going to say management is completely and totally false, they're committing massive fraud. Actually, they wouldn't say that in a report. It would be a lot more diplomatic, but you can kind of get the gist of what we're going. And something that's really important to note, we've already alluded to this in this course before, but the idea behind the Sarbanes-Oxley Act in this section with respect to PCAOB standards is that auditors have a responsibility for testing controls of internal control of publicly traded companies, specifically internal controls over financial reporting. Now, the way that we do this is pretty intuitive, but it's very important to define. So PCAOB Auditing Standard 2201, and remember when we talk about PCAOB, these are public company auditing standards. It states that the auditor must conduct the audits of a financial statement and ICOFR, internal controls over financial reporting, in an integrated way, because each audit provides the auditor with information relevant to the evaluation of results of the other. So these are not independent assessments. When you're performing an audit of financial reporting under publicly traded rules, you also have to perform an audit of internal controls over financial reporting. So these are separate but related audits. And the idea behind the statement integrated is that information that we learn as part of our testing of the controls will give us information about the audit and our financial statements, and vice versa. And information that we learn from the financial statements will give us information about the controls. We're going to talk a little about this idea of the integrated audit here in just a little bit, but it's important to know when I refer to integrated audit, what that means is that we are testing controls and financial statements within the realm of the same audit engagement. All right. So we alluded to this at the end of chapter 6. You remember there was that final slide that said this is just a preview. We said that there are 3 different categories of control deficiencies. Now, we've just generally got our basic level of control deficiency. Control deficiency basically is if there's a problem in controls, but we have not defined the scope of the problem. This is also our lowest level of deficiency. So if we don't escalate it beyond this level, we just say this is a rogue control deficiency. It's not a big deal. Failures happen. Now, just as a reminder, there are 2 categories of control deficiencies at the general level. The first is when the controls are not present or they've not been designed. That's going to be a deficiency in design. So the controls just basically aren't there. That's how we think about deficiency in design. Now you can have a control that is present but is not matched what we need. That could also be a deficiency in design. Example is that we're concerned about, or the client should be concerned about the existence of revenues, but they design a control that addresses completeness of revenues. That would be an example of a deficiency in design. There is a control, but it does not actually match what it needs to be. So, but generally speaking, it's going to be the control is not there because the control we need is specifically for existence issues. What about if a control is present but not being followed? That's what we call a deficiency in operation. That was an example that we talked about already. We said segregation of duties. Is it possible segregation of duties can be properly implemented but be ignored? Absolutely, absolutely. If we define the functions of people within a certain person or personnel area, say you're responsible for custody, you're responsible for authorization, you're responsible for recording, and they say whatever, we're just gonna ignore that. That's a deficiency in operation. The control is not being followed. Now, this is kind of our general categorization of controls. What happens if a control is going to be something that is problematic, but not necessarily going to result in a material misstatement? This is kind of our middle ground when we call it a significant deficiency. Now, a significant deficiency by definition is something that, if left unchecked, will be likely to result in a material misstatement in the future. Likely to result in a material misstatement in the future. So I've got a really, really embarrassing example that I always use for this. Anybody have a car when they were in high school? Did you take good care of your car? Yeah, I didn't. Okay. I was a slacker. I'm still a slacker, but I'm a little bit more responsible now. So my parents actually gave me this massive blue van. It was like one of those cargo vans that we had for when I was growing up. We used to drive around the country for trips, and it was kind of on its last leg, and it really needed a lot of TLC to make sure it was maintaining. I was 16, 17 years old. I was like, I can't bother with that. I like having something I can drive with, but why bother taking care of it? So do you know what happens when you drive a vehicle without changing the oil for a long period of time? It will work in the short term very, very well. In the long term, it does not exist. Okay, that does not work properly. And that's what I found out the hard way. It's like saying, oh, that check engine light. I probably should check the engine. I just don't know what I'm checking for. Well, the engine's still there. No. I knew that I needed to change the oil. I should have known better. But again, like I said, I was very irresponsible when I was younger. So if you can go and tell all your friends, Dr. Barnes was irresponsible when he was younger, they'll say Dr. Barnes is irresponsible now. Yeah. So yeah. The example of that being is saying is that if we drive a vehicle with no oil in it, is it a problem now? Not really. Is it going to be a problem in the future? Absolutely. That's an example of our significant deficiency. What about something that's a problem now? A control issue that's likely to result in a material misstatement. We call this a material weakness. Material weakness, by definition, is a control issue so severe it is likely to result in a material misstatement in the financial statements. Now, if you ask another accounting faculty, they may say when you buy some curtains and actually the cloth has a material weakness, but that's not something actually Dr. Eisen said. But if I think you asked him that, that's probably the kind of response you'd get. There's a lot of these I have a lot of fun with attributing things that they didn't actually say. I'm assuming that someday I'm going to have a student that's not going to be paying close attention. And I'm going to say, did Dr. Kane actually say that? I'm going to ask her about that. I'm just going to say, no, Dr. Barnes is making things up like he always does. So yeah. Can't all be teasing Dr. Kane though. Got to spread out the love there. So now how do we determine what the deficiency represents? So there's going to be 4 different categories that we could operate within. We could actually say there's no control deficiency whatsoever. There's a control deficiency, but it's just the lowest level of control deficiency. There's a problem, but it's not a severe problem. That's going to be a significant deficiency. And then there's a material problem. That's going to be our material weakness. But how do we delineate between those 4? And the answer is we're going to judge on 2 characteristics. One is going to be likelihood, and the other one is going to be magnitude. Now, both of these have to exist to some degree in order for a control deficiency to take place. So this is going to seem really familiar. This sounds like probable and reasonably estimable back from 303. And it's a very similar concept, but it's a little bit different because we're going to have to delineate what these represent. So in order for our control deficiencies to actually take place, it has to be at least reasonably possible. It has to be at least reasonably likely to occur. So here's kind of our graph here. If we say that it's a remote likelihood of occurrence, then we're not going to acknowledge that there's a control deficiency. Now think about this. What would happen if a meteor hit the Earth right now? That's a sizable meteor, not like pebble-sized, okay? That would burn up the atmosphere. Like something the size of a car hit the Earth. It would probably cause a lot of casualties, a lot of problems right there. Now, I know we don't think a car is too big, but we're talking about something that's hurtling at thousands of miles an hour into the planet. Okay, so why do we not have like a giant meteor shield surrounding the Earth right now? Well, our likelihood is very, very low. The likelihood that we're going to have a meteor problem that's going to hit the Earth that's going to result in that kind of devastation. Last time that really happened was like 65 million years ago. Now, it was a pretty severe one. The dinosaurs did not have a lot of controls in place. Those they're no longer here. But it was not a likely occurrence. In 65 million years, we've not had anything to that degree. So it's a remote possibility. So if it's a remote possibility, we're not going to bother ourselves with that level of efficiency. What if we say that it's at least reasonably possible or probable? That's when we start examining what we think of the magnitude. Now, if we think it's a reasonably possible item, but it's not going to be material or significant, we're just going to leave it at controlled efficiency. If we think it's not material, but it is at least significant, remember, that's the van running without oil, we're going to say that's significant efficiency. And if it's likely to result in material misstatements, that's where we say it's a material weakness. Now, over here, I want you to know that this is going to be relevant. We're going to talk about this a little bit more later on. But depending on the severity of the controlled deficiency, we're going to report to different parties. Any controlled deficiency will be reported to management regardless of the severity. Anything that's significant deficiency or up will be reported to the audit committee. And then material weaknesses always get reported externally. They actually go into the auditor's report and presumably go into the management report, assuming they're doing their job. They are willing to acknowledge that there's a material weakness. All right, let's get into the granular details now. I think I've used that term twice. I've noticed myself that whenever I use a word once, I like to repeat that word over time. So let's go ahead and get to the details here about what's going to be happening with respect to the audit of iCopper. Evaluation process has 3 steps. First of all, identify our financial reporting risks and related controls, consider which locations to include in the valuation, and evaluate evidence about the operating effectiveness of iCopper. So what are the steps that we're going to be walking through? Well, the steps follow a very similar routine to what we look at with respect to a financial statement audit. Now, we're going to perform these kind of in step with those financial statement audit because, as we already know, SOX requires that we perform this in an integrated way because information from one will be relevant to the other. That's why we're going to achieve both objectives together as an integrated audit. So when you hear that term integrated audit, all you need to think is we're performing test of controls, test of internal controls or financial reporting. I should probably be test of iCopper and financial audit or the financial statement audit. We're performing those audits simultaneously. So this looks very similar to what we're going to be talking about with regard to a financial statement audit. There are a few important differences, but we're going to go through those. Now, please make a note for your preparation for this exam. The next few slides are very, very tedious and a lot of information is conveyed in there. I'm going to give you a lot of details and some notes here. Historically speaking, this has been an area where my students have really struggled because they do not take these slides seriously. It's like, oh, it's too much information. I can't fit all that in my brain. And then I ask a question. It's like, that's so unfair. All right. I can tell you with 100% certainty, there will be at least a few questions from these slides that I'm about to present. Okay. Probably at least 2 multiple choice questions, if not more, that can get conveyed in the problems. And there will come up very heavily from these slides. So you do need to focus on these slides in your study preparation. This is a very, very important area of emphasis. All right. So in planning, the auditor considers the following activities: the role of risk assessment of the risk of fraud, the scaling of the audit, and the use of the work of others. So role of risk assessment, why is that important? Because if we don't know the risks, we can't identify if our client has implemented the proper controls. So risk assessment is our starting point. Scaling the audit is pretty straightforward. This is basically saying how important are particular controls in certain areas and how much emphasis should we put on them. If they're very, very minimal importance, we don't need to perform a lot of work there. If they're really, really prominent, if they're a significant risk area, we need to put a lot of emphasis on that. And then using the work of others, we've already talked about this before. If we can actually use the work of the internal audit function, then we can actually gain some assurance in their responsibility. Fun fact, if you go back to 2005, I should have deleted this statement right here. Back in 2005, when SOX was still starting out, auditors were not allowed to use the work of the internal audit function. So they had to redo all the work themselves. Can you imagine being an internal auditor, say, spend all this time working on internal controls, and the external auditor just replicates my work and worse than I did it? Yeah, that's got to be an ultimate thing. And the firms themselves were really, really angry because they were like, we're paying for this extra audit work that's completely unnecessary. You know who was really happy? The accounting firms. They were making bank right there. Yeah, so that was a good time to be an auditor right there. You were working a lot, but you got a lot of free perks. I think I had like 5 weeks in a row that we ate at someplace really, really nice for lunch almost every day. It was good. It was pretty amazing. Anyway, going on. So next step is going to be identifying the controls to test. Now we're going to talk about something we haven't really alluded to, but let's talk about entity level controls. in general, when we talk about controls, remember those are transactional in nature. And I've said, remember, controls relate to transactions and events. There are exceptions to that rule. We do need to talk about some of those exceptions today because we do, as auditors, have to evaluate entity level controls as part of our testing of internal controls or financial reporting. So entity level controls, they can actually be pretty straightforward. Some things you've probably heard about. You've probably heard of a code of conduct in place of companies that represents an entity level control, and whistleblower hotlines. You're probably familiar with those, reporting risks of fraud. Something you may not have thought about as controls, but the control environment. Remember that first component of the COSO framework? That represents entity level control. And this is going to blow your minds, okay? The period and financial reporting process is like, oh, I remember that. That's something I learned back in 220. We prepared the financial statements for the end of year. That's not a control, Dr. Barnes, because we were doing that back in 220. It isn't completely a control. Can you believe that? You learned about controls before you learned about controls. So think about the purpose of those financial statements is to check and make sure that management is actually performing the job that they say they're doing. It's a check against the risk of misstatement by management by the owners. Anything that's a response to a risk, that's a control. Okay, so you guys learned about controls before you actually called it controls. You can feel a lot smarter now because you were learning things before you actually knew you were learning them. So it's another example of entity level control. Then we go down to the more the lower level of detail, the significance and disclosures of the relevant assertions, because we're going to be identifying the transactional areas, because most of our controls testing will deal with transactions and events. You need to understand the likely sources of misstatements and then select controls to test. We are going to be at a very basic level testing those entity level controls. Not really significantly, we just need to have a basic understanding of whether they're operating properly, but we're definitely going to spend a lot of time focused on the controls testing of those transactional items. Moving on. So how do we actually dictate the scope of the work that we're going to be doing? So evaluating the design and testing and operating effectiveness controls. First thing we need to know is the nature of procedures we can perform. Now, at some basic level, this is going to depend on what it is that we're trying to do the test to work up. And we'll see an example when we look for our walkthrough here in just a second. But the type of procedures are going to be pretty representative of the things that we talked about with respect to evidence back in chapter 5. So remember, tested controls, we had 5 procedures we can talk about: section record documents, observation, inquiry, reperformance, and walkthroughs. Those are going to be the types of procedures that we perform during this phase. And we're going to see those repeated here in just a second. Also, the extent, the number of tests and sample sizes. These will make a lot more sense when we actually walk through chapter 8 and 9 and talk about sampling process. But as we need more assurance, we need more information. So we need to perform more tests and perform a larger sample sizes. So depending on the risk level, that's going to dictate how much work we're going to be doing in a certain area. Then also timing, year-end versus interim. Which one gives us more assurance, by the way? Interim or year-end testing? It's just last week, guys. I know you guys have slept since then. Come on. Year-end testing gives us more. Why? Because we have all the information, okay? If we test it interim, we get some work done early, but we haven't looked at all the information for the period. So year-end testing is going to give us more assurance. So we need to make a determination. Can we get by with testing an interim, or do we need testing year-end because we have to have more assurance in that area? Those interesting questions. All right. So I said that we're going to be working through it. So just as a quick note, if you want to walk along with me, I'm going to put this on the screen. But you will notice that in week 7, there's a thing called the iCoffer testing example. That's going to be what I'm walking through here. I used to print these out and hand it out, and then I realized that I was probably just giving you extra paper that you didn't need. So you can walk along and make notes along with it if you wanted to see this, but I'm going to have this on the screen. So Bill Boyd, he's the manager for Emmett Shin, and he's doing some testing over the cash received in the bank lockbox. Now, when we talk about a bank lockbox, what does that mean? Has anyone heard of that mechanism before? It's not like a big metal lockbox like DSP uses for concessions. That's not what we're talking about here. All right. We're talking about a kind of a virtual object that banks, when they receive cash disbursements from customers, they will automatically apply that to the transactions for the entity. So say that you've got your business over here, you set up a bank lockbox in your bank. Instead of sending cash receipts from customers to the company themselves, they send it to the bank lockbox. Instead, the bank says, here's what we received in your account. You can apply that. Now, what's the purpose of that control? If I send a check directly to if I'm an auditor, I'm seeing them receive checks directly themselves. Is it possible those checks could be stolen, could be used for misappropriation? Yeah. So if we send it directly to the bank instead, it reduces the chances of misappropriation taking place. So this is effectively a control trying to prevent the misappropriation of those cash receipts. Now, there's some interesting points there because does create some complication with respect to the bank lockbox. So the entity receives from the bank an electronic file listing of cash received from customers. So cash receipts come from customers, and the bank sends us an electronic list saying, here's everything that was received. The IT system automatically applies the cash receipt from the lockboxes to individual customer accounts. So we see what the cash receipts are. The bank system tries to line up the cash receipts as best as it can. The cash receipt lockbox not applied to a customer's account is on an exception report called the unapplied cash exception report. Now, what does that mean? So the bank has got a listing saying, here's what we received. We apply that automatically to the system. The system says, all right, they owe $30, they send in $30. Check. Okay. They owe $100, they send in $100. Check. They owed $50, they send in $48. Exception. All right. Why did they send in $48 when they owed $100 or they owed $50? That would be an example of the exception that we operate from. We're trying to make a determination of what's going on. So this is going to be an application to cash. This one right here is called a programmed application control. Now, we already know about application controls from AIS. This is something the system does. The review and follow-up of the unapplied cash receipts exception report is called a manual control. So basically, the report comes out and said, we received cash, we don't know where it goes, or the system doesn't know where it goes. So somebody has to be responsible for making sure they follow up on that and say, why did we receive this cash and where is it supposed to be going to? That's somebody's responsibility in the organization every time that report comes in. So Bill says, I want to determine whether the statements of cash, which primarily relate to the existence assertion, accounts receivable, existence, and BAA completeness, would be prevented or detected on a timely basis. In order to test these objectives, decides to test the manual control. Now, first of all, do we think that what Bill's doing makes sense? So try testing, make sure that these cash receipts are appropriate and they're getting dealt with in a timely manner. Would you say, I want to test the application control or I want to test the manual control? You probably are saying, I'd do both. And say, kudos to you for being thorough, okay? But if we had time on our hands, which one would we want to focus on more? Which is more likely to be the source of misstatements? The application control, the automatic control, or the manual control? The manual control, because whoever's responsible for manual control says, I just won't bother with this, or they could kind of misappropriate the assets themselves. Whatever it is, we want to make sure we're checking that human beings work. So let's go ahead and see what's going on here. So determine whether there's a listing of non-matching cash items or reports. So following tested controls to make sure that the review, to test the effectiveness of the review and follow up on the daily unapplied cash exception report. So basically what Bill is saying is I'm going to test and make sure that I understand what happens with this manual control and it's working appropriately. So what would be the first thing logically that you would do? If you're an auditor and you're trying to gain an understanding of this control, what would be the very first thing that you would do? Say, excuse me, Dr. Barnes, you work for this company. Can you tell me how this control works? What do we call that step? Inquiry. That's what Bill does right here. Inquire to the entity personnel about the procedures in place to ensure all unapplied items are resolved. Test the time frame in which the resolution takes place and whether unapplied items are handled properly with the system. So understanding the nature of this manual control, how it works, what the time frame for resolution is, and what happens with anything that can't be resolved. So I think that's a good first step. Now, the reason I say first step is, have we reached the point that we're satisfied with the operation of this control? No, for a couple of reasons. First of all, we don't have any answers. Secondly, what type of procedure was this again? It's an inquiry. What's the reliability of an inquiry? Low, okay? So anybody we talk to, we can't just take their word for it. We have to corroborate. Fortunately, Bill's a good accountant. He's a good auditor. So he talked to me about these matters, was happy with what's going on. So then he said, I'm going to reperform the control. Okay, what's our reliability on reperformance? High, okay? So assuming that Bill does the job properly, we're going to be very happy with the results of these tests, okay? So Boyd selected 25 daily unapplied cash receipt exception reports in the period from January to September and reformed the follow-up procedures that the employee performed. Select the documents, source of information, determine the transaction properly corrected in the system, scan the other data cash exception reports, determine the controls performed throughout the period of intended reliance. Okay, I scrolled down too far. Let's go ahead and stay right there. All right. So Bill retest the control. He did exactly the same procedures that the company personnel were for 25 of the days. Now, assuming that's an appropriate sample for testing, okay, I'm not going to judge whether the sample is sufficient. That's going to be something we talk about on Wednesday. But assuming that's a sufficient sample, and he's happy with the performance. Are we good here? The answer is yes, but what's the follow-up? What's the follow-up caveat? I'm going to say yes, but what do we know here? What are the 3 words that we have to be very, very careful about? What are the 3 words that we have to be very careful about? Yeah, what are the 3 words that we have to be very careful about? January to September, okay? Does that represent an entire year? Wouldn't that be great if that was the entire school year, January to September? Okay, just take off October, November, and December. Just enjoy life. I guess that would just be the same as summer break. Never mind. All right, never mind. Okay. Yeah, it's not an entire year, unfortunately. So even if the control is working properly during that period, does Bill have some responsibility to check and make sure the control is still working at your end? We talked about that last week. The auditor does have some responsibility for checking interim testing to make sure it's still operating at your end. So what did Bill do? He did follow-up tests. He made sure that since it performed at interim dates, he actually asked about the procedures performed at year end. He did the same scanning and then did a check to make sure that they were still performed on a timely basis and did not have any exceptions noted. All right, so that was pretty much the test. Now, aside from the fact that we didn't do any integrated testing, we actually did put our hands on it. Does that make intuitive sense for what's going on here? Saying, make me understand the control and then testing the control. All right, that's all there really is to this process. That's all there really is to it. So we're going to be walking through a little bit more. That's an example of how we would do this, how we would actually perform these tests. Okay, moving back to the slides. So now we have to determine what's going on with control deficiencies, okay? Now, discussed earlier, severity of control deficiency depends on 2 factors: the possibility of commission control will fail to prevent or correct a misstatement, which is our likelihood, the amount of potential misstatement resulting from the control deficiency's magnitude. Now, again, this is really important because if we do not assess this properly, we will not assess the nature of the control properly. And this is important because control deficiencies, depending on the control deficiency, we're going to have to report that to different parties. So if we assess something as only a significant deficiency, when in fact it's a material weakness, that could result in a material misstatement that goes undiagnosed. That's one of the problem that we could actually have there. Now, I'm going to walk you through a couple of examples, and I do want you to make a note on this because this is really important. In the book, for these next 2 examples, and also the book for your homework, you're going to have to make a choice from 2 options, okay? You're going to have to make a choice between the significant deficiency and a material weakness. On the exam, you'll have to make a choice between 4 options. You'll have to make a choice between control deficiency, significant deficiency, material weakness, or no deficiency whatsoever. There is no deficiency. Now, we've talked about the nature of those, and it's not particularly difficult to make the jump from this to the other one, but I wanted you to be aware that just because you only have 2 options in the homework does not mean that's all I'm holding you accountable for. So make sure you think about this. And when we go through the homework on Friday, I'll say, what would change if this was, and I'll give you some examples of what might be a control deficiency or what might be no deficiency whatsoever, so you can actually become acclimated to all 4 types of deficiencies. But for some example here, let's talk about this. This is going to be either significant deficiency or material weakness. Murray Company processes a significant number of routine intercompany transactions on a monthly basis. Individual company transactions are not material and primarily relate to the balance sheet activity. For example, company cash transfers between business unit finance operations. A formal management policy requires a monthly reconciliation of the incoming accounts and operation balance sheet between business units. However, there's no process to ensure performance of these procedures. There's no follow-up or immediate procedure. As a result, detailed reconciliations of accounts performed on not performed on a timely basis. Management does perform monthly procedures to investigate selected large intercompany account differences. In addition, management prepares a detailed monthly variance analysis of operating expenses to assess their reasonableness. All right. Based on your expansive knowledge of significant deficiencies and material weaknesses, which you basically got 20 minutes of experience with this, do you think this is a significant deficiency or material weakness? Significant deficiency. There's actually 2 pieces of information that allude to this, okay? The first one should have been obvious when I yelled out not, and then followed that with material, okay? Not material, okay? So it has to be material in order to be representative of material weakness. The other one is a little bit more subtle. At the end, it said, look, there's a control failure in this area, but there's also redundant controls in this area that could probably stop a control weakness or a misstatement in this area. So the fact that redundant controls exist in this area probably means, or at least review in this area, means that it's unlikely that we're going to result in a material misstatement with respect to this. Right. Everybody on board with that? Let's do one more because there was so much excitement. I saw the thrill in your eyes. Okay, the eyes were twinkling all around. It was great. All right. We're good at a company process a significant number of intercompany transactions on a monthly basis. Intercompany transactions relate to a wide range of activities, including transfer of inventory and other company profit between business units, allocation of research and development cost of business units, and cover charges. Individual intercompany transactions are frequently material. A formal management policy requires monthly reconciliation of company accounts, confirmation of balance between business units. However, there's no process in place to ensure that these procedures are performed on a consistent basis. As a result, reconciliation of intercompany accounts are not performed on a timely basis, and difference in intercompany accounts are frequent and significant. Management does not perform any alternative controls to investigate significant intercompany account differences. All right. What do you guys think? Significant efficiency or material weakness? Material weakness for the reasons that we just talked about on the previous slide, but for the opposite, okay? Frequently material, and management does not have any remediating controls. Here's an interesting question for you. This might be relevant to your homework for you to think about. Let's say an individual transaction, or you've got several individual transactions. We'll say it doesn't. Individually, a transaction is not a material amount, but together in aggregate, they are material amounts. Would you judge the deficiency of that particular control to be material weakness or significant efficiency? This is a trap, isn't it, Dr. Barnes? Not really. Okay. This would be a material weakness if the aggregate of deficient or aggregate of misstatements in that area was going to be material. Remember, we're thinking about what all the total combined misstatements would be. So even if an individual intercompany transaction is not material, if there's an aggregate, they are material, then that would be a material weakness. By the way, I got the comment last semester that when I started this video, because these are long slides and I'm not going to read them off so slowly. I'm not going to do like internet company processes significant enough because we'd be here till next year when that assignment was due. And but I said that was a really good opportunity for students to actually go to 200% and see what that really sounds like on YouTube. So if you're ever just really, really bored and need something to do, check out. And when I'm reading really, really hyper speed, what does that sound like on 200%? I've never done it, but I've just been curious. All right. So what happens if we identify a material weakness during interim testing? Do we just let it go? The answer is maybe, maybe not. We go to our client and we say, you've got a material weakness in controls, and they say, can we fix this in time before the financial statement audit report is issued? Before the audit report of Rycoffer is issued. The answer is if you can get all the work done. This process is known as remediation, correcting a material weakness in internal controls or financial reporting. Now, it's important to note, remediation does not fix the existing problem because the problem existed for however long the control deficiency is. So assume that we were at 6 months in and we say there's a material weakness in that coffer. That means for 6 months, this control is operating with the possibility of a material weakness. Now, presumably, this should be captured by the financial statement audit, any material weakness or any material misstatements. But we do offer the option to the client to say they have fixed the control, it is no longer a problem, meaning that we don't have to issue an extreme opinion. There are some conditions to this, though, that we need to be very aware of. First of all, if a material weakness is corrected for the as of date, and this is basically when we say the issuance of the financial statements is usually when that happens, the as of date, there must be sufficient time for both management and the auditor to test the operating effectiveness of the control. Now, this is really important. If management alone tests the operating effectiveness and the auditor does not have time to test the operating effectiveness, we cannot remediate the control. Both parties have to be able to test the control, which is a big ask right there. Because management has to fix the control, they have to check the control to make sure it's working properly, and the auditors have to do the same thing. So what happens if the auditor or management is not able to properly assess the control after it's been fixed? We're going to issue an adverse opinion, which is a spoiler, by the way, because we're going to be talking about the types of opinions that we can issue for internal controls or financial reporting. All right, so that's remediation. Again, it's possible for a client to fix problems before they have to issue the financial statements, but they have responsibilities they have to meet in order to do that. If they can fix the problem and make sure everything's corrected and we have time for testing, then the good news is that we don't have to resort to a bad opinion. So let's talk about the opinions going to be rendered. So just like financial statement audits of ICOFR do result in opinions being rendered. Now, this is a separate report from the audit or opinion on the financial statement. And the good news is that we're not going to look at specific reports. When we get to chapter 18, you guys are going to be very, very angry with me because we're going to look at a report and it's going to be long and detailed. And I'm going to say, isn't that really, really difficult? Says, I will never remember all that, Dr. Barnes. And I'll say, just hold on. We got 4 more. All right. So yeah, there's a lot of detail to go through. I'm not going to throw you under the bus and say, we're going to actually learn internal controls reports as well. Now, if you're planning on for the CPA exam, no promises. All right. So this is going to be a different report that you will not be responsible for learning, but you do need to understand the logistics of this report. So presumably, if the controls are operating properly, then we can say the report or the opinion that's being rendered is going to be unqualified. Okay, an unqualified opinion. I'm honestly not sure if it's well, we're talking about internal control over financial reporting. I think it's going to be unqualified in both respects because this is usually just done for public companies. But what happens if we do have control deficiencies? The answer is, what's the answer to all accounting questions? It depends, okay? What does it depend upon? Well, it depends on what type of deficiencies are existent in the controls. If it's just a control deficiency or a significant deficiency, we still issue an unqualified opinion. So say that we've got multiple control deficiencies or multiple significant deficiencies, but no material weaknesses. Then we can issue an unqualified opinion. And you may be saying, wait a minute, Dr. Barnes, that doesn't make any sense because significant deficiency is still a problem. What was our definition of a significant deficiency? It's not a problem now, but it will likely be a problem in the future. Which means that there's a significant deficiency that goes unchecked. Now, we're going to look back a year from now and say, did you fix that problem? If they said no, it's like, well, we're probably going to issue a material weakness now because you did not fix a significant deficiency. You've been driving that van without a oil for a year. It is probably broken down. All right, that's the problem. I'm glad my suffering can give you all such enjoyment. It's like, yeah, Dr. Barnes is kind of a fool. That's true. It's true. Still is to some degree. Anyway, yeah. So no significant, no change in opinion for control deficiencies or significant deficiencies. Where we have problems is we have material weakness. A material weakness is likely to result in a material misstatement. When you have material misstatements under GAAP reporting for financial statement audits, that's where you issue adverse opinion. Same holds true here. If we have material weakness, that's an adverse opinion on internal controls over financial reporting. Now, just as a reminder, these are just opinion types for the audit of internal controls over financial reporting. This is a separate report. You will notice that there's nothing in the middle here, okay? We've got 2 types of opinions that can be rendered, unqualified opinion and adverse opinion. There is no qualified opinion. No such thing as a qualified opinion. We're talking about audit by COFR. There is, however, still the possibility of a disclaimer of opinion. What was our definition for disclaimer opinion? When is that primarily going to be rendered? What were those 2 words? 2 words that we talked about. Scope limitation. When our scope has been restricted, we can't do our job. So that's what I want to do. So if our scope has been restricted, we can't actually test controls effectively. We still can issue a disclaimer opinion, especially if it's a significant or pervasive scope limitation. So 3 types of opinions that could possibly be rendered: unqualified, adverse, and then the disclaimer of opinion is going to be a situation where we just couldn't do our job properly. That's presumably not going to come up very frequently with we're talking about publicly traded companies, but it can come up. There's also the possibility of very, very extreme scenarios where you can withdraw from the engagement. Again, that doesn't happen very often, but it's certainly an option for the auditors. All right. What about some other reporting issues? So we do need to know about subsequent events. You'll notice I say in chapter 17, we are going to allude back to this in chapter 17, which we may be talking about chapter 17 next week. When I first used to present this, I used to go in chapter order. I jump around a lot in chapters now. I think we're going to talk about subsequent events next week. This is not subsequent events we're talking about from financial reporting purposes. We will talk about those in chapter 17 as well. But when we refer to subsequent events in this regard, we're talking about changes in internal controls after the balance sheet date. So let's say we're auditing the year 2025, and there's a massive change in internal controls in January of 2006. Do we as auditors still have responsibility for that? You betcha. Yes, we do. Okay, for as long as we're on the engagement, we are going to be responsible for changes in internal controls, even if they're not under the period under audit. So that's what we mean by subsequent events here. Also, if the auditor decides to refer to the report of other auditors, we do need to allude to that. We're going to talk about this in chapter 18 from the context of the financial statement audit, but the rules that we're going to talk about in chapter 18 will still apply to an audit of internal controls or financial reporting. So the same rules still apply. It depends on whether the auditor is willing to take responsibility for the work of other auditors. Again, you don't need to worry too much about that. Just remember that this is something, when I talk about it in chapter 18, it says, yes, I remember Dr. Barnes talked about that in chapter 7 as well. The rules are the same for audit of ICOFR and audit of financial statements. Now, management report is incomplete or improperly presented, okay? So remember, under Sarbanes-Oxley Act, section 404, management has to issue their own reports, and they've actually got to assess the internal controls of financial reporting. So they have to disclose it and present their own report. What if they present the information incorrectly? If it's incomplete, they haven't actually finished the report, or the information there is incorrect? The answer is that we as auditors will modify our report to reflect management's gap. So our report is going to be changed ever so slightly to say, here's the deal. Management's information is wrong. Here's what's wrong. We just thought you should know. What about if management's report is complete, but what if it's a little too complete? What if they present additional information that's not relevant or has not been part of the audit? So they've got a full report, they do things, and then they started talking about like a casserole recipe at the end, okay? Which it's awfully nice of them. A good casserole is really hard to find sometimes, okay? Does anybody else like casserole? I haven't had casserole in a long time, but a good, like tuna casserole is one of those things that I really enjoy. Maybe not tuna, okay, all right. So yeah, contains additional information. Have we audited that information? We have not, okay? So we are going to disclaim any responsibility on that information or that additional information. We will disclaim our opinion on that information. That is not saying we're disclaiming an opinion on the entire audit of ICOFR, just on the casserole recipe, okay? Just on that. It's like, you know what? This tuna casserole recipe looks really good, but we haven't tested it, and we don't have an opinion on it, okay? So it's important to note that. What about reporting on remediated material weakness at interim date? What does that mean? Well, remember we talked about remediation has to take place within a very specific time frame, and it's possible that we don't get to that point. We don't have enough time for management to assess the problem and the auditor to do their follow-up assessment. What if management, shortly after the issuance of financial statements, fixes the problem? Are they just stuck with an adverse opinion for the rest of the year? Like, well, we fixed it like 5 days after the report was issued, and now we're going to be stuck with a report for the rest of the year. The answer is no. We can remediate as an interim on an interim date. So if remediation occurs, they fix the material weakness, we can jump in and say, here's the deal. On our original report, management had not fixed the problem. But as of this date, which is the interim date between after the issue of the financial statements, but not before the next year, they fixed the problem. And now we no longer believe that there's a material weakness in internal controls, which is really important for people who are relying on that detail. Say, oh, there was a problem, they fixed it, now we can rely on management again, okay? Still don't want to eat that tuna casserole recipe, it doesn't look good, but still, the controls themselves look great. All right, last thing. So, auditor must communicate in writing to management and audit committee all significant deficiencies and material weakness identified during the audit. Communication made prior to the issuance of audit reports, auditor's report over ICOFR. So just as a review, I alluded to this in an earlier slide, but this is going to be really important for you to know for the exam. When we're talking about just a control deficiency, we're talking about the base level of deficiency. These are just problems, but not significant or material. We only communicate those to management, just management. If we're talking about significant deficiencies, we communicate those to management and to the audit committee. We're talking about material weakness, we communicate those to management, to the audit committee, and it also gets reported externally in our audit reports. Now, that's the important thing for you to know, okay? So control deficiency, management only, significant deficiency, management, audit committee, material weakness, everybody gets to know. But the auditor should also communicate to management in writing all control deficiencies identified in the audit, okay? So we have to actually, we're going to tell them all the control deficiencies, and we're going to tell the audit committee when that communication has occurred. So even though we don't share all the control deficiencies with the audit committee, they do get to know when we tell management that information, because they're going to be responsible for the follow-up and say, hey, did you fix those control deficiencies? Management says, I'm working on it, I got casserole in the oven, right? So they're going to fix that. Well, I don't know why I'm so focused on this casserole thing. Just one of the things came out of my mouth and now I can't shut up about it. Anyway, so audit committee does have to actually follow up on the work and make sure that that's going to be something that gets taken care of at some point in the future. So that's why we make that communication to them so that they know, even if they don't know what the control deficiencies are, that management should be responsible for taking care of them. And that's pretty much it for chapter 7. We got chapter 8 and 9 on Wednesday. I'll see you all then.